Have you looked at the financial headlines lately? Because honestly, it feels like a massive contradiction. On one hand, literally everyone is talking about the high cost of living, global uncertainty, tight budgets, you name it. But then on the exact same day, you pull up the charts and see major indexes, the S&P 500, the Nasdaq, the Dow Jones, absolutely smashing records, just rocketing toward all-time highs. So why is everything hitting an all-time high right now? And more importantly, is this surge actually built to last, or are we just standing on the edge of a cliff? Well, stick around because understanding the mechanical secret behind this rally is going to completely change how you view the modern economy.
And looking back over the past few years, it has been a completely wild ride. Seriously, think about it. Back in 2022, we were getting hit with aggressive rate hikes. By 2023, there were these widespread, almost daily recession fears. Everyone was bracing for impact. And then, defying all the anxieties and grim predictions, we get this sudden explosion to record highs as we move through 2024 and look out toward 2026. The contrast between that recent economic anxiety and the current booming stock market data is just staggering.
So, welcome to Everything You Need to Know About Finance. I am so pumped to guide you through today's explainer. We are breaking down the AI and rates hype, figuring out exactly how we avoided a crash, revealing the hidden mechanics behind this massive surge, and exploring the future of the market. Let's get right into it. Just a super quick heads up before we dive into the heavy hitters. This explainer is strictly a deep dive into the economic data and current market mechanics. It is absolutely not financial advice. We're just unpacking the numbers to see what they tell us. And hey, if you find this kind of content interesting, please like and subscribe. It really helps us keep bringing you these deep dives.
All right, let's look at the first major bucket driving the current boom. Section 1. The hype and hope. AI and rates.
We have to start with the heavy hitters powering this rally. We're talking NVIDIA, Microsoft, Apple, Amazon, and Meta. These companies have grown into absolute titans over the past few years, completely altering the stock market landscape. The Nasdaq, for example, is incredibly heavy with these specific tech giants. They are the ones actively building out the massive AI infrastructure and software ecosystems of the future. And because they make up such a massive chunk of the overall indexes, when just a few of these giant companies rise, they essentially drag the entire market up with them.
But why are they rising so fast? Well, it all comes down to the concept of forward-looking markets. You gotta remember, investors aren't just rewarding these companies for what they did yesterday. A huge part of this rally is purely based on belief. Investors look at artificial intelligence and they see a shift that's as monumental as the invention of the internet or the smartphone. So they're aggressively pricing in that future growth years ahead of time. People are buying into the revolution today because they expect astronomical returns tomorrow.
And then there's the second half of the hype, the interest rate narrative. Let's walk through exactly why the market surges just on the expectation of changes. Step 1. Investors start to expect that central banks are going to cut rates over the next year. Step 2. That expectation means borrowing is projected to become cheaper. Step 3. Cheaper borrowing means companies can expand their operations much more easily, which mathematically makes their future profits more valuable. And finally, step 4, seeing all this potential, investors rapidly pull their money out of safe, boring bonds and throw it right into stocks. The market moves fast, right? It doesn't wait for the rate cut to actually happen. It buys the rumor.
But here's the thing. All that hype wouldn't matter if the broader US economy was actually collapsing. Which brings us to Section 2, the reality check, avoiding the crash. Because despite all those aggressive rate hikes we talked about earlier, the US economy showcased shocking resilience. I mean, we maintained relatively low unemployment, consumer spending stayed incredibly strong, people just kept buying things, and corporate earnings held up way better than anyone expected. This resilience positively surprised the markets and basically prevented the massive recession that so many analysts insisted was a done deal.
Which leads us to the ultimate dream scenario, the soft landing. This is what every central bank and investor prays for. It's a scenario where inflation successfully cools down to a totally manageable level, but the broader economy doesn't crash into a recession. I literally cannot overstate how incredibly bullish this specific combination is for stocks. Once the market realized a soft landing was actually on the table, it was like pouring jet fuel on the rally.
Okay, so we know the why, but what's actually happening under the hood? Let's dive into the mechanical secret behind the headlines that most people completely miss. Section 3. The mechanics, the big reveal. This totally destroys a very common misconception. The S&P 500 is not equally weighted. Because it's market cap weighted, the top 7 to 10 largest companies completely dominate the index's performance. So the big reveal here is that if these massive tech giants surge, they can literally drag the entire index to a record all-time high, even if the remaining 490-plus smaller stocks are completely flat or even losing money. So next time you hear the market is at an all-time high, remember this. Under the surface, this rally has been incredibly concentrated in just a few hands.
And that concentration? It creates this massive, powerful engine that keeps those top companies at the top. It's called the passive feedback loop. Let's step through it. Step 1. Millions of people automatically invest part of their paycheck every single month into 401ks and ETFs. Step 2. Massive index funds, run by giants like Vanguard and BlackRock, take that money and automatically buy into the index, which means buying the largest companies. Step 3. Because of this constant, massive buying pressure, those big companies and the overall indexes rise. Step 4. Because they are now even larger, they command an even bigger share of the next month's automatic investments. It is literally an automatic money machine, continuously flowing into the market.
But wait, we do have to look at the math from another angle. If you compare real economic growth with nominal growth, you see a really key distinction. Real growth is actual, tangible expansion, selling more products, innovating. But part of this huge stock growth is simply nominal growth, which is driven by inflation. Think about it. If everyday prices go up, a company's revenues naturally go up, and their profits rise in dollar terms. And consequently, their stock valuations rise too. So it's absolutely vital to understand that a portion of these all-time highs isn't pure innovation. It's just a reflection of inflation and the monetary expansion we've seen over the past few years.
So, bringing this all together, where do we go from here now? That we understand the mechanics of the surge, let's get into Section 4, Future of the Market.
First off, we need to be crystal clear on what all-time highs do not mean. Reaching a record high on an index does not automatically mean we have a perfect economy. It certainly doesn't mean that stocks are cheap right now, and it absolutely does not mean there is zero risk. Historically speaking, markets can and do hit record highs right before recessions, or while there is deep geopolitical uncertainty lurking in the background. The coast is never entirely clear just because the chart happens to be pointing up.
I want you to really focus on this quote. Investors are pricing the future, not the present. It reiterates our earlier point. The market is a forward-looking machine. But there's a big warning attached to this. After very long, extended rallies, markets can become quite expensive relative to the actual hard earnings companies are making today. When valuations get stretched this far out on future hopes, it dramatically increases the risk of serious volatility if those hopes aren't perfectly met.
But let's zoom out for a second. When you measure timelines in decades rather than days, the perspective shifts completely. Despite all the risks, despite the high valuations and the concentrated tech rally, U.S. indexes historically spend a surprisingly massive amount of time hovering near all-time highs. Why? Because over the long haul, human innovation, economic expansion, and corporate profits just naturally tend to grow. The overarching long-term trend of the market has always been upward. Which leaves us with this final, provocative mystery to ponder about the future of the stock market. As these long rallies make markets increasingly expensive, are we currently pricing in a perfect future that simply hasn't happened yet? Are investors just assuming flawless AI integration and perfectly timed rate cuts with absolutely zero economic speed bumps along the way? That is the ultimate question you have to ask yourself as you navigate these record-breaking times.
Well, we have covered a ton of ground today, from market cap weighting all the way to the psychology of forward-looking investors. If you want to continue mastering these concepts and exploring more fascinating financial deep dives, please try out our latest episodes. Thank you so much for learning with me today. Stay curious, and I'll catch you in the next explainer.